Mortgage rates falling, inflation easing, and a potential base rate cut on the horizon. Let's dive into this week's news in the UK mortgage market. So this week we're seeing a wave of reductions from several lenders, a shift in lending criteria for the self-employed, the latest inflation data, and an interesting twist at the latest Bank of England meeting, with markets now firmly eyeing a cut in the base rate in August. Plus, house prices continue to settle post stamp duty changes. So first up, mortgage rates. Well, Santander and Clydesdale have both trimmed their 2 and 5 year fixed rates, with Santander's cuts focused on the higher loan-to-value products, namely 85 to 95% loan-to-value, whilst Clydesdale's reductions apply right across the board, covering all loan-to-value levels and even product transfers for existing clients. So whether you're buying or remortgaging, there is some value to be had out there. On the buy-to-let side, LendInvest have slashed their rates across all their fixed rate product, with Accord also shaving a little bit off their new business buy-to-let range. Now, looking at lender criteria, TSB made a noteworthy move this week, upping the loan-to-income multiples for self-employed clients to 5.5 times income. This brings them into line with some of the other lenders that are out there in the self-employed market. So if you're self-employed and you're wondering what this might mean for your borrowing potential, feel free to pop a comment below. Looking at the wider economy, inflation stayed flat at 3.4% in May. Now, before everybody jumps into the comments and says, but inflation actually dropped to 3.4% in May, Craig, don't forget that the ONS openly admitted a few weeks ago that they'd actually made an error in the previous month's figures, and that the previous month's inflation data should have been 3.4% and not 3.5%. So in actual fact, inflation stayed flat despite all of the press suggesting otherwise. That said, concerns do remain though, particularly with all the unrest in the Middle East, which is pushing oil prices higher. Energy costs in the UK could continue to climb, putting more pressure on inflation readings. But the big one though was the Bank of England meeting. As expected, the MPC held the base rate at 4.25%. But this wasn't a unanimous decision. Expectations were that 7 people would potentially vote for a hold, but that was only 6, with 3 members actually voting for a cut in the base rate. And that's key because it strongly signals a potential base rate cut in August. So after so many months of holding, do you think that we'll finally see a cut in the base rate at the next meeting? Please do let me know your thoughts below. And lastly, this week, property prices. So the latest ONS data shows that the average property price in the UK rose 3.5% year on year to April 2025. And whilst that sounds positive, that's actually down from 7% the month before, which of course we did expect because it showed the slowdown after the rush to beat the stamp duty deadline. Looking ahead though, I personally expect growth to remain fairly steady as we head into the second half of 2025. So what does all this mean if you're thinking of buying, remortgaging, or investing in property? In short, lenders do seem to be competing again, with slightly sharper rates and more flexible lending criteria starting to creep back in. But with uncertainty around inflation and what the Bank of England will do next, borrowers should stay alert and keep their options open, especially those of you that need to remortgage later in the year, of which there are apparently about 1.8 million. So it's shaping up to be quite an interesting summer. But how are you feeling about the market right now? Are you holding out for a base rate cut? Or are you ready to lock in a deal now before rates potentially move again, whichever direction that might be? Drop your thoughts in the comments below because I'd love to hear them. And as always, don't forget to give me a follow so that you don't miss next week's update. I'll see you then. Take care.